Welcome back to The Explainer, everyone. Today, we're tearing down the blueprint of ABM Industries' Q2 2026 financial performance. Now, facility solutions, I know it might sound like background noise, but trust me, it is actually the invisible backbone of our entire modern economy. Whether you're tracking these markets for work or you just kind of love seeing how multi-billion-dollar companies actually make their cash, we're going to break this whole thing down together using the raw data straight from their earnings report. Let's get into it.
Okay, so here's our blueprint for today. We've got 5 stops. 1. A record-breaking quarter. 2. Mapping the revenue. 3. The 3 growth engines. 4. Profitability and the bottom line. And finally, 5. The blueprint for 2026.
All right, Section 1, a record-breaking quarter.
$2.3 billion. Just let that sink in for a second. That is a massive foundation for just 3 months of work. This actually represents record Q2 revenue for ABVM, up an incredibly impressive 8.4% compared to the same time last year. It instantly tells us, right out of the gate, that they've got some serious momentum happening at the top line.
But how did they get there? Well, 6.1% of that was organic growth, meaning the core existing business is just naturally expanding. The remaining 2.3%, that came from acquisitions. And this is a really vital distinction. Organic growth is pretty much the golden metric for a healthy company. It tells us that, yeah, strategic buyouts are adding some nice structural support, but the vast majority of this massive revenue, it's being driven from the inside out.
Moving right along to Section 2, mapping the revenue.
The sheer scope of their work perfectly captures just how vast and end-to-end ABM's business really is. We are definitely not just talking about a single service here. They operate across incredibly diverse markets. We're talking cabin cleaning for major airlines, managing massive parking operations, running clean rooms for tech manufacturing, and, amazingly, even building out electrical infrastructure and microgrids. They literally touch almost every facet of the physical spaces where we work, travel, and learn every single day.
So, when we break that revenue down, business and industry, or B&I, is the biggest foundational piece at 44%. That's their traditional commercial office space stuff. But look at the 4 other pillars holding this up. Education brings in 20%, technical solutions is at 14%, manufacturing and distribution adds 12%, and aviation brings in 10%. It's a seriously diversified mix.
That brings us to Section 3, the 3 growth engines.
Okay, this is where things get really explosive. We are seeing double-digit growth in 3 specific areas compared to the rest of the business. Technical Solutions, or ATS, is up a massive 27.2%. Aviation grew by 19.5%, and manufacturing and distribution jumped 16.5%. These right here, these are the real accelerators pushing the whole company to those record heights.
Let's zoom in on that primary engine for a second. Technical Solutions. You might be wondering, how do you organically grow a segment by almost 30%? Well, you position yourself right in the dead center of the green energy transition. This surge is being completely powered by huge demand for battery energy storage systems, major data center projects, and optimized HVAC setups. And the absolute kicker? They just landed a massive new microgrid project worth over $100 million. No big deal, right? Over in aviation, that near 20% jump is largely driven by a huge new contract win at Heathrow Airport, plus just a super strong domestic travel market overall. Meanwhile, manufacturing and distribution is totally riding the wave of the semiconductor boom, and they're getting some extra horsepower from their recent Star acquisition, which is apparently performing incredibly well.
But here's the crucial contrast. While tech, manufacturing, and travel are absolutely soaring, their biggest segment, business and industry, sat perfectly flat. 0% growth. Nothing. And honestly, this just perfectly reflects the reality of commercial office spaces right now with the whole hybrid work shift. The growth just isn't coming from traditional office buildings anymore. It tells a much bigger story about real estate in general. The big money is flowing straight toward infrastructure and specialized facilities instead.
Let's shift gears to Section 4, profitability and the bottom line.
Because as we know, making money and keeping it are 2 very different things, right? There is a big gap between standard accounting and operational reality. GAAP net income was $43.1 million, but their adjusted net income came in higher at $52.9 million. So why do we care about the adjusted number? Because it strips out all the messy one-time accounting events to give us a much cleaner look at their everyday performance. And when you look at their adjusted EBITDA, it was actually up 5% year over year to $131.7 million. So operational profit? it is definitely growing.
So why the difference between those two net income numbers? Well, ABM had to absorb some pretty heavy headwinds this quarter. We're talking higher interest expenses on their debt and a specific $4 million incremental amortization expense from that WGN Star acquisition we mentioned earlier. But the good news is they successfully offset those costs with a lower tax expense and by really tightening the belt on corporate costs.
Now, taking a slightly more analytical look here, the segment operating margin dropped from 7.9% in Q2 of 2025 down to 7.3% this quarter. And look, investors obsess over this metric. Margin compression simply means that for every dollar of revenue they bring in, slightly less of it is actually making its way down to the bottom line compared to a year ago.
But we can't just look at percentages in a vacuum. We have to connect that drop to real-world challenges. This wasn't just money vanishing into thin air. Margins got hit by very real frictional costs. Think adverse weather events, TSA security inefficiencies early in the quarter that totally slowed down the aviation segment, the heavy initial costs of just getting new aviation clients, like Heathrow, up and running, and a shift in the mix of newer contracts. These are real-world operational problems directly impacting the spreadsheet.
And finally, Section 5, the blueprint for 2026. $1.2 billion. That is their record for first-half new sales bookings. So yes, they just posted record revenue, but this number, this tells us they have successfully loaded up a massive pipeline of future work. The demand for what they do is absolutely there. And the brilliance of having that massive backlog is reflected right in their forward guidance. Despite all those margin pressures we just went over, ABM is maintaining its adjusted earnings per share outlook for the full year at $3.85 to $4.15. Keeping this guidance totally unchanged, that sends a very strong signal of confidence in their structural stability going forward.
So summarizing CEO Scott Salmier's expectations for the rest of the year, the blueprint basically relies on 4 pillars. 1, they expect meaningfully higher volume to continue in their technical and manufacturing segments. 2, they anticipate a more profitable service mix. 3, they're going to keep pushing cost savings and pricing initiatives to fight off that margin compression. And 4, from a balance sheet perspective, they are aggressively targeting a leverage ratio below 3.0x by year-end by paying down debt.
Which really just leaves us with this final, absolutely vital question to ponder. With such incredibly strong momentum in their tech, manufacturing, and travel segments, can ABM's growth engines continue to outpace the flatline reality of traditional commercial office spaces in the back half of 2026? It is the core tension of their entire business model right now, and honestly, it's what makes watching this company so fascinating. Thank you so much for hanging out with me for this explainer. Until next time, stay focused and keep learning.